Hi, everyone.
Okay.
Sorry we're a few minutes late. You'd think we would have all of this figured out on the, what is it, Ryan? The 120th day of working from home and however many Zooms we've done, but a little last minute technical difficulties. So thanks for bearing with us. We will, as I see all of our participant numbers climbing, we will go ahead and get started. My name is Jen Frisk. I'm a Senior Managing Director at Newmark Knight Frank. My partner Ryan Harding is on as well. He's to my left on the screen. Don't know where he is on yours. He's an Executive Managing Director. We have a team called Office Created, and you can follow us on Instagram, our website. You should have all of that information. We're happy to send it. But we represent clients and tenants as it relates to their office space, both in Los Angeles and globally. Newmark is a global commercial real estate firm, and we also have Roy Abernathy on the phone or on the screen, who we will introduce in more detail later. Roy heads up our workplace strategy for the entire company and is going to be talking about what this all looks like when we all eventually go back to the office. But we're very excited today to be co-hosting this with Covington Capital Management, dear friends of mine, and I am going to turn it over to Susan Wolf, who is the Managing Director and Head of Business Development for Covington. In my book, her Rolodex and ability to connect people is unparalleled. So I'm going to turn it over to them for a quick overview on the markets, which I'm very curious to hear. And then we'll come back to Ryan and myself and Roy and get into our information about returning to work.
Thanks, Jen. Hi, everybody. Thanks for signing on. I'm going to take a minute and introduce Covington and then introduce our Covington speakers and then get our show on the road. So what do we want you to know about Covington? We are a SEC regulated registered investment advisor with about $3 billion under management. We serve high net worth individuals, multi-generational families, family offices, foundations, and nonprofits. We are privately held and owned by the professionals who actually work in the business. We have a very distinct business model where each client gets their own portfolio manager who builds them a customized portfolio of individual securities and then actively manages that portfolio rather than relying on products or outside managers. Today we have two Covington presenters. You can read their bios, so I won't read them to you. Amy Lange, who is a managing director and a portfolio manager, actually runs our fixed income team, and they manage about $1 billion in fixed income securities. If fixed income questions keep you up at night, Amy is your thought leader on yield curves and negative interest rates and Fed policy and really important things of that nature. So you'll hear from her. We also have Scott Swanson, also a portfolio manager, but on the equity side, building those customized portfolios and actively managing them. And, you know, of course, as an investment professional, Scott watches at CNBC, but not what you might think, because he's a total car geek. His favorite show is Jay Leno's Garage. So on that note, we're going to get started. We want to get to talking about investment themes for the future, as Jen said, if we ever get out of the house and back to work. But before we can look forward, we actually need to look back. So Amy, Scott, what happened in March in the market meltdown? You know, who were the winners and losers there?
I can jump in.
Please.
Okay. Thank you, Susan, and thank you, everybody that's joining us today. It's been an interesting year. The year started out really strong. It started out great in January, February. The economy was doing well. Unemployment was near record lows. And then we get to the middle of February, stock market hits an all-time high, and then COVID. COVID started spreading, and 22 trading days later, the S&P 500 was down 34%, erasing $12 trillion in stock market value, again, in just 22 trading days. That obviously created, you know, a high level of uncertainty, a high level of fear, and in situations of uncertainty and fear, what you want to own are the highest quality assets. And that's what we've always gravitated toward. For us, high quality assets mean strong balance sheets, access to liquidity. And this concentration, this focus on balance sheets was validated by the markets during the decline. This is a chart put together by Goldman Sachs. And the blue line is an index they created of companies with strong balance sheets. And the gold line, of course, is companies with weaker balance sheets. And as you can see, the companies with stronger balance sheets went down a little bit less, but have recovered a lot stronger than the companies with weaker balance sheets. To give you an example of just, how quickly the world turned upside down, imagine for a moment that you're the CFO of Starbucks. In January, things are great. You're expanding rapidly in China. The United States stores are doing the best that they had done in the last 3 years, and everything's great. And then February, COVID hits China, and the company is forced to close all 4,000 of their stores. And then by the end of March, the company's closed nearly all of its 32,000 stores around the world. In effect, the company went from generating over $400 million a month in cash to now potentially burning $500 million a month in cash, depending on how long all of the stores remain closed. Fortunately for Starbucks, they did have a strong balance sheet. They had a healthy cash position going into this, and they had access to untapped credit lines. So, at the end of March and all the way through April, they were able to use that cash, tap those unused credit lines, and it got them into early May. And in early May, the credit markets, which Amy will describe in just a second, began to function a lot more smoothly, and that allowed Starbucks to basically refinance all that short-term debt they took on in their credit lines with new long-term notes, and they successfully, repaid those credit lines and got through to the other side. Today, I believe over 90% of their stores are open again in some capacity, and the company expects to again start earning money on a monthly basis beginning this month. So again, having a strong balance sheet and having access to the credit markets allowed Starbucks to get to the other side. But maybe I'll hand it over to Amy, then she can talk about the credit markets during the crisis. Amy, you're on mute.
Great, thank you. The stock markets and bond markets are definitely intertwined, as Scott was mentioning, so that companies can access the credit lines. What was happening in March is that as stocks were selling off, what people don't realize at the same time, risk assets and bond markets were selling off at the same time. And what was going on was there were too many sellers and not enough buyers. So this chart is showing you that we had record outflows from mutual funds and ETFs. And with those too many sellers, it really locked up the credit markets. So as panic struck all asset classes, people sold all sorts of risk assets. But what you'll see here is that the orange lines, which actually make up the most of these sales, are actually in bond funds, taxable and muni bond funds. So all of this selling in risk markets actually caused a lot of buying in risk-free assets such as U.S. Treasuries and cash. Well, as we know, when there are so many buyers, it makes the price go up and the yield go down. So Treasury yields hit a historic all-time low of about 0.65%, and that is actually where we are trading about right now on 10-year Treasury yields. So what happened with this credit lockup is the Federal Reserve had to step in, and having been through a similar experience back in the global financial crisis, they were ready to act with a myriad of actions. We call it an alphabet soup of liquidity facilities, as well as lowering the overnight interest rates to zero, buying up treasuries and mortgage-backed securities. But the liquidity facilities were really important to businesses, as Scott mentioned, and municipalities and investors. So you can see on the left that the balance sheet of the Federal Reserve was increased from about $4 trillion to $7 trillion in this time. And this, along with the $2 trillion CARES Act, actually caused the markets to eventually loosen up and begin trading on fundamentals instead of fear. So similar to the stock market, in the bond market, these are various sectors of the bond market, and you can see the roller coaster that we experienced throughout March and through May and June. And what you can see is that the higher quality, so those investment grade corporates are higher quality, outperformed, meaning they had a lower dip and a stronger rebound than the lower quality parts of the market, such as bank loans and high yield. So that's where we stand right now.
So Scott, that talk about alphabet soup, that sure looks like a V right there. Where are we now? We're going to have a V-shaped recovery? What's our alphabet soup for the recovery?
There is an alphabet soup for the recovery. It's interesting. I mean, first of all, the data that's been coming in over the last several weeks confirms that the economy bottomed in April. Obviously, it was a very sharp and deep bottom that was struck, but it happened quick. But the indicators, many indicators have already turned around. And now America's favorite pastime is trying to assign a letter to the slope of the recovery. We think that a lot of companies and a lot of businesses are going to have a different shape to the recovery. Certainly there'll be some V's, but there'll be some U's and probably even some L's. When we think about the V's here, for instance, I think you'd want to think about businesses that have been shut down, but were really deferred maintenance. So things that were put off for the last few months, but you can't put off indefinitely. And I think at the top of that list, I think of elective medical procedures. When hospitals started dealing with COVID, basically the rest of the hospital shut down and all elective procedures and surgeries and things like that were canceled. I mean, everything from heart valve replacement and repair to hips and knees and, gallbladder, et cetera. All of that stuff was put on hold, but obviously none of that stuff's, deferrable forever. And meanwhile, new cases continue to pop up. So it's creating a tremendous backlog of medical things that need to happen over the next several months. And in fact, some hospitals have already talked about, and some surgery centers have talked about, when they get the green light to, go do more of these elective procedures again and clear the backlog, they'll work longer hours and they'll even work weekends. So clearly the medical device companies, there are a number of high quality medical device companies that have seen their business interrupted, but I think that they'll be back pretty quick as we clear that backlog of procedures. And you can think of the same thing then with, the vet, taking your dog to the vet, that's been on hold, going to the dentist, et cetera. So a lot of those things should resemble a V. I think one other one I'd mentioned, since we're talking about getting out of the house, is automotive. The cars have been parked for the last 3 months, but I think as we look ahead to this summer, there's obviously going to be a reluctance to fly. There's going to be a reluctance to use public transportation. So I think auto usage is going to probably take off pretty strongly this summer, and that'll create opportunities for auto parts companies and even new auto sales, et cetera. So that's how I would think about the V's, or deferred maintenance. I think if we skip to the U's, here I think about the recovery is more challenging for a lot of these businesses because a lot of them are going to be dependent on capacity. And for a lot of businesses like theaters, theme parks, restaurants, they're going to reopen at diminished capacity. And that's going to be a challenge for a lot of businesses. Theme parks think they can reopen, and break even at about 30 to 50% capacity. But restaurants think they might need to be at 80 to 90% capacity. So it's going to be a much more uneven and longer recovery as they're able to ramp capacity. The interesting thing also about these businesses, and many of these are the hardest hit businesses in since the crisis, when we think about retail, restaurants, entertainment, hospitality, leisure, travel, JP Morgan estimates that these businesses collectively were about 20% of GDP last year, but they also estimate that these businesses were only about 7% of S&P 500 profits last year. So that actually kind of starts to explain a little bit this disconnect that we've seen recently in the stock market and the economy. At least a lot of people think there is a disconnect. And part of it is, a lot of these hard hit industries aren't necessarily as big in the S&P. And then when we go to the L's, quickly on the L's, I chose that font for the L on purpose, just to give it some hope that there might be some slope at the end. But these are the businesses that I think are going to take confidence to come back. And for most people, confidence is going to be a vaccine. So when you think about international air travel or cruise ships or stadiums, concerts, et cetera, it's just going to be a longer road back, I think, until they really, start to look like, pre-COVID again. And then finally, there are some people that are actually throwing around the W now, and I don't even want to go there. So I think I'll just kick it back to Amy.
Okay. So as we're waiting to find out if we have a V or a U or an L or a W, I get the question a lot of, well, if yields are so low, Amy, why do I own bonds in the first place? I'm not getting anything from my bonds. So I'm going to answer that, as I've gotten that question a few times. We own bonds for 3 reasons. One is capital preservation. Bonds are less volatile than stocks because of their income component. The income that you're actually getting from bonds is a good place to hide out for a while and earn some income. And finally, diversification from equities, which is what this chart is showing you. The last 5 times we've had a large sell-off in the equity markets, the bond market has been either flat or up. And so this is why we own bonds in the first place. But given that yields are low, we talked about the Treasury 10-year being at 0.65, so all Treasury yields under 1%. Where do we go for opportunity except for government bonds? While we saw most sectors rebound, there is still some room in some fixed income sectors in the market. So we do still see opportunity in the high quality corporate market, high quality municipal bonds, and high quality mortgage-backed securities. In fact, after-tax income potential for municipal bonds far exceeds what is typically available in the taxable bond market, as this chart is showing you. The left-hand bar is the Bloomberg Barclays U.S. Aggregate Index, which is a taxable bond index of 1.3%. And if you actually are in the highest tax bracket in California, that actually turns into a 2.7% taxable equivalent yield. So there is still some value there. One caveat, though, I will say, if you can afford to get the diversification, oh, I disappeared. Sorry about that. We would suggest that security selection is really important. As we saw, mutual fund flows can drive a market, and so sitting in a bond where you know you're going to get it at maturity is a good place to hide out while you get the income. A little bit more specifically on the corporate side, we think there will continue to be some stress in some parts of the market. Hospitality and travel, obviously, the energy market, but where we do see opportunities in large banks and healthcare and communications. On the municipality side, there are, again, some places to worry about, as Scott mentioned, things like convention centers and concert halls, some smaller hospitals, and even nursing homes. But we do see value in, obviously, the well-funded, higher income tax base municipalities, general obligation bonds, some transportation systems and higher education systems that maybe were unnecessarily hurt in this sell-off, but actually had appropriate reserves coming into the crisis to wait it out. And then finally, one asset class that isn't talked about often is a hybrid asset class, which are preferred stocks. Preferred stocks are securities that are higher on the capital structure than common stocks, but they pay a high dividend like a bond. So they can be volatile, especially in a rising interest rate environment. But as we said, we do expect interest rates to stay low for a while because the Federal Reserve is committed to zero interest rates for a long time. And so we do see some value here in earning some income. They are usually issued by financial institutions, as you can see on the left. That's that blue, the blue area. And financial institutions are actually came out of 2009 stronger than ever because of regulation and consolidation after the global financial crisis. And so the right-hand chart is showing you the bank capital ratios that are much higher than they were before the global financial crisis. So we do think that this is a place where you can put a little bit of your money and earn a little bit of extra income.
So, all right, you guys, we looked at where we were and where we are. Now, where are we going? What are you seeing for long-term trends into the future?
Well, I can start. And I think in a word, I would just say digitization. In his company's earnings conference call earlier this week, Sanjay Mehrotra, the CEO of Micron Technology, stated, quote, "Clearly certain trends that would have taken 2 to 4 years to develop have been accelerated into months." So let me give you a few examples. First, I think that's going to take off is contactless pay. The United States, believe it or not, is actually way behind the rest of the world on contactless in-person transaction. The rest of the world, over 60% of in-person transactions now are done contactless. Here, it's still less than 10%. And it's not like the technology doesn't exist here, it does. There are over 200 million tap-to-pay credit and debit cards already in circulation. There's over 100 million or so digital wallets. So we certainly have the technology. I think a big part of it has just been education. I know personally, I've walked into some retailers and asked, "Do you have tap-to-pay?" And they kind of shrug and look at me like they don't know what I'm talking about. I tap my card on the terminal and it works, and they're surprised. And so, we just need to, I think, do a better job of both educating consumers and merchants, as well as continuing to update the point of sale systems to accept this technology. But I think consumers increasingly are going to demand it, as they increasingly want to shy away from cash. I think the next one is to talk about is telehealth. Again, telehealth was starting to happen, but it was really happening fairly slowly. And then obviously COVID hit. And one of the big breakthroughs on telehealth in the crisis was Medicare. And Medicare immediately broadened a lot of the coverage for telehealth and virtual visits, and in fact, made virtual visits reimbursable at the same rate as in-office visits. So that greatly opened up the market for people to now tap in, virtually to their doctors to try to get everything from a COVID diagnosis to anything else that was going. I think beyond that, beyond just virtual visits with doctors and telehealth, the real big wave, I think, is going to be, remote monitoring. And that's going to be with wearables, with smartphones, watches, bracelets, and now even rings that monitor all kinds of, body and behavioral functions that allow diabetics to be monitored, hemophiliacs to be monitored, mental health patients to be monitored, all remotely and all in real time, aided by AI systems that allow people to intervene when somebody, when a wearable device picks up some sort of problem with their patient. And finally, I think, as 5G takes hold in telehealth, that's going to expand all the way out to where you'll be able to someday see remote robotic surgeries. So, there's going to be a whole wave of digitization going on in healthcare that is going to provide a lot of opportunities. And then the last one I'd mention is, again, the digitization of large enterprises. As the work from home showed the last 3 months, companies and large organizations now have their employees spread throughout the world, and people from a park bench or a kitchen counter now have access to all of the company's systems and all of the mission critical systems. And so all of that needs to be updated. Security needs to be updated more. Cloud services, consulting services. There'll be a lot of companies, I think, that benefit in the next few years of what I would call annuitizing digitization. Software as a service companies, again, consulting companies. There's going to be significant investment in the mission critical aspect of a lot of large organizations. And then finally, before I close, I do want to mention REITs. REITs are an important part of our investment toolkit. And if I were to talk to people about looking at REITs right now, I would just say to look at the same sort of broader trends that we're seeing in the rest of the economy. And I would look at REITs that house data centers, logistics REITs that have warehouses, REITs that have cell phone towers, and even storage REITs. It seems like maybe a lot of people might be on the move over the next couple of years. And then, maybe on the other side, I'd probably be careful with REITs that are in malls, and I'd probably be careful with senior living facilities because I'm not sure where all that's headed. So I think with that, I'll kick it back to Amy and let her explain how we're going to pay for this crisis.
Sure, you leave me to the tough one. So yes, as Scott mentioned, we do need to pay for it at some point. We talked about the Federal Reserve backstopping our credit markets and a little bit about the fiscal stimulus of trillions of dollars. This chart is showing you what the CBO had estimated for the deficit to be about $1 to $2 trillion for the next 10 years. But now after the CARES Act and the Potential Heroes Act, hopefully coming later this summer, the CBO actually expects $4.2 trillion this year of a deficit and an average of $2 trillion for the next 10 years. This will, as you can see on the bottom chart, bring our federal net debt to GDP up to about 128%, higher than even the 106% that we had back after World War II. So what does this mean? Well, in the short run, the good thing is that it does mean economic growth, and it does look to be working. In the long term, though, we will have to pay for this debt eventually, which will mean higher taxes down the road, lower spending, probably higher inflation, and unfortunately for our kids and grandkids, more income inequality among generations. In a higher tax world, we mentioned municipal bonds, they're double tax free, so they will again benefit. again, security selection is key. We did talk about some of the themes that we should watch out for in areas that might benefit from the shutdown. And with higher inflation down the road, there could be some value in Treasury inflation protected securities. These are TIPS, and these are Treasury government backed, and they're Treasury securities, but they trade on break-even rates for inflation. So the Fed has a 2% inflation target right now, and currently our 10-year inflation rate is being priced at about 1.37 and our 5-year at 1.15. So while we do expect probably deflation in the near term, in the long term, TIPS or Treasury inflation protected securities will probably offer some value. So that wraps up our stock and bond market update and outlook. We hope we answered most of the questions that came in. I know a couple came in today that we were unable to answer, but we do want to turn it over to Newmark now. And if we do have, we will get back to you and answer your questions on a personal basis. So here you go, Jen.
Thanks, Amy. Thank you, Scott and Susan. That was enlightening. And I think Roy now will touch on some of the similar trends that you talked about with digitization and tech. So with this, we'll turn it over to Roy Abernathy. Roy is our head of global workplace strategy at Newmark. He will tell you more about this, but he has a background in both architecture and infectious diseases with a specific focus on zoonotic diseases. So in his words, he's been waiting his whole life for this. He joins us from Atlanta, so he has an interesting perspective from a state that is a little bit ahead of where we all are in California. And he's going to run through, and I'm excited to see this because we hosted a webinar a couple of months ago, and I'm sure there's been a lot of changes. So unless Ryan has anything to add, we'll turn it over to Roy.
I thanks for all of you that are rejoining. I've noticed a lot of people repeats from Roy's last presentation, so there's clearly others that are excited. So thanks, Roy, for doing this, and we look forward to hearing from you.
And I'll do a series of updates as we go through this too, because it's been a few weeks since the last time we talked. And as you've seen in the news, we're in kind of the resurgence. We're not willing or ready yet to say that this is a second phase of the virus. But Scott, I hope that we don't end up with the same W that you weren't quite at yet relative to the virus because of its effect both on the economic side, but also on the human health side. So, a few weeks ago, we talked about kind of this continued view of after COVID and kind of the implications currently and those implications going forward. A lot still around the pressure on cost short term and really looking at, both how to find the capital to kind of weather the nature of this, but also the pressure to kind of reorganize or reshape the business. I'll talk a little bit more today about what we've learned from a workplace perspective as an update on that. And a lot of the conversations today about how many people will come back and how they want to come back to the office. From an organizational perspective, we're still seeing a lot of kind of like reorganization around different business types or different models. I think that question about kind of how quickly we'll recover, or we might recover, Amy and Scott did a great job on. So I learned a lot today, guys, just in kind of what you see as the dip in April, and I hope it's a V, certainly more than the L for most businesses. And then from a political perspective, we're really hoping that a lot of this kind of calms down by the end of the year and that we have some more stability on that side. But there are going to be a lot of issues around how does local government, especially city government and regional government, pay for how they emerge from this, because in a lot of cases, the federal government is not investing in local, regional, and city government the way that they have in the past. So an update on how we're returning. We're seeing escalations in the virus around the globe. And I will tell you it's more triggered by behavior, and we'll talk about that specifically today. Transportation is our biggest bottleneck. We're actually working with even the Metro Transit Authority throughout New York City to understand those implications, but and I'll show you how the workforce is really looking at that. Cleaning regimens are really, underway broadly. So I think Scott touched on kind of that as a future and investment opportunity. And then how buildings reboard are going to be critical. There's no way to really provide a COVID-free building. And we're going to see more implications of that as we come back and as we see these spikes. But, most buildings or most landlords, most employers are following the CDC's guidelines or recommendations and taking temps, screening employees before they come back, increased daily cleaning. And then I don't know if you saw the most recent update for iOS on your iPhones, but it actually included the contact tracing that we've been talking about as a platform, but you have to opt into that on your phone. So if you have an iPhone and you're willing to do this, I would suggest today you do that, both for your personal and family health, but also from a population medicine perspective. And then we've at this point retooled a lot of our offices to be able to come back with a 6 foot or 2 meter social distancing. So in many cases, the offices are ready for people to come back before we're actually bringing them back. And so as an example, most of the organizations who've offered up to 20% of the workforce to allow them come back, we're seeing between a 2 and 12% adoption rate initially of people actually coming back into the office. And most organizations are doing it on an opt-in model. And we're still seeing a lot of implications around family, and especially waiting to see what schools are going to do for the fall. And I know here in Georgia, the schools actually have given us an option, and I think we start back earliest. So my kids go back the first day of August, back to school. So we're roughly a month out at this point. And we have 3 options. We can choose to keep them at home, we can choose to do a hybrid model, or we can choose to send them back to school full time. And so, but we think that that pattern of choice is going to kind of telegraph from corporate America into our education system as well. The scary thing, and this is using H1N1 and the 2009 pandemic as an example of the wave. So Scott, I guess here's my inverted W to some extent. And I think if anything, hopefully we're in what was the second phase of H1N1, but take specific notice at the exponential increase in the spikes between the different models. And while COVID doesn't track exactly to H1N1, these patterns have been repeated as we look back in history across different viruses. So to some extent, we're kind of pushing through it as a model in the way that we're treating it currently. And there are going to be kind of open and closed implications relative to some of those different business types that Scott and Amy touched on as we go through this process. So what you're going to see certainly from a thermography perspective and from a screening perspective, the CDC issued their guidelines for the office finally, I think 3 weeks ago. And we've been working with them for a number of months, but they issued a number, I guess there are 14 kind of critical criteria that you should follow, but 2 of the primary ones are screening. So asking employees a key set of questions each day before they come into the office to confirm that they haven't been exposed. One of the worst things that can occur is have someone who has been exposed make it into your office and then demonstrate symptoms when they're in your office, because that triggers a whole set of protocols that you have to go through now to inform the other employees who are in the space, your landlord, and then potentially even visitors and other people that employee may have come in contact with. So from a reboarding process roadmap, there are roughly 14 steps that the CDC outlines that you go through. And I've gone through some of this in the past, and we've got it on our website, so I won't spend a lot of time on the nuances, but I will point out the most critical factors related to what it takes to really retool and prepare for people to come back. Again, the biggest implication we're seeing is around behavioral change. And one of the doctors that we work with at FDA made it clear the other day, and she said that the virus likes to live more in the human, within our bodies, than it does in the environment. And so that makes behavior much more critical than even the cleaning aspects of what we do. And so you see those states who have had a resurgence in the virus, it's because they didn't follow the behavioral protocols, more so than they didn't follow the cleaning protocols or the separation protocols. So if there's anything we can get across, still continuing to wash your hands, socially distance, and wear a mask when you can't are the 3 most critical factors to controlling the virus. Talking to your landlord and certainly kind of working through that in the process, but also the environmental best practices. Again, I know we've done 12 million square feet just in the last 30 days of planning for organizations to come back. And so from an environmental perspective, there's a very clear outline of what to do to socially distance and protect our workforce as we come back into the environment. And I think, Scott, you're right. It's funny when you go to Europe or when you went to Asia before COVID, we're much less touchless than our counterparts around the globe, and we're paying the price for that at this point. So you're going to see a drastic escalation or transformation around that, and everything from calling an elevator to touchless pay to other aspects of what we do. And you're going to see buildings sense more our occupancy than they ever have in the past and react in a predictive way rather than us changing a thermostat, rather than us touching a door, rather than us kind of doing the high touch things that we've done in the past. So it's kind of orange is the new black. The new high touch will be no touch. And we talked about this last time from a behavioral perspective, that the handshake to some extent is something that we're going to put on the shelf for the next 9 to 12 months. So I like the digital hug in what we do, but something that conveys it. It's interesting. I was on a series of calls yesterday looking at from an educational platform and working with a neuroscientist on how to read impressions from people when they're on screen versus trying to do it physically when you're in the same room. And so we're going to see new education platforms come out of that. We're going to see new retooling within our workforce and especially within our sales force. How to read those nuances when you're trying to sell to someone digitally versus selling to them physically is going to take off from a transformation and from an education perspective and from a commerce perspective. From a protocol perspective, the CDC is very clear in outlining that you have to do a risk or hazard overlay. And so anyone who has not done this for your office, this is one of the 14 protocols and probably the most important from both protecting the workforce, but also protecting the organization from potential transmissions or fault relative to this. And they've outlined very specifically, and we tried to tailor it to something that's very digestible, ways to really go and identify high risk, medium risk, and low risk relative to your office environment and be able to convey that to everybody from the janitorial service to your workforce as you come back. The second is capacity and making sure you don't put more people in a floor area than we can really accommodate from a social distancing perspective, and then helping the workforce understand that. And then third, and this is probably the biggest implication today, looking at the workforce and who needs to come back, who wants to come back, and who can remain at home for an extended period of time. It's interesting if you look back over history, teleworking started in 1972. In some cases today, before the majority of the workforce was born. And so when you think about the research and the history we have in this, we know how to do it well. We have a great background on how to do it. We know how the technology's changed and supported us over time. But we're kind of doing this in a bit of an erratic mode today because we're all being forced to do it at the same time. So if there is anything we can convey as you look to come back and you look at your workforce and who's going to want and need to come back, don't base your decisions on the information that you've collected over the last 90 days, because we've been in a honeymoon period where working from home has been easy. We've all been learning and doing it at the same time, and nobody's back in the office for us to really compete with yet. All that's going to begin to change over the next 90 days. And we're already seeing implications around kind of the transition from month to month to month. So the data on the right-hand side is from PwC's survey back in May 8th. And it said, or basically from that survey, the takeaway was 30% of the workforce wants to return, 70% doesn't. The survey data we have from the beginning of middle of June is that number has doubled. And so it's inverted to now 60% of the workforce wants to come back, and only 30% says that or wants to work from home for the majority of the rest of their professional career. And the fears around getting COVID at work, the unwillingness to use public transportation, that these concerns are beginning to allay over time. And the biggest implication is, nobody had gone back yet. Nobody was in the office yet. And now we're starting to see the patterns. And we're seeing that, honestly, the risk is not at the office. The risk is in a bar. The risk is really in the places where we congregate socially, not the places where we congregate professionally. And so, the biggest risk is not going to be where we work, is the message out of all this. And we're going to see people more and more want to return back to the office. But when they return back, they want to return back with the opportunity to vary their schedule and to be able to work from home and work from the office a portion of the time. So now if you go back and look over that last 50 years of everything from telework to the most recent kind of flex work platforms, there are a lot of different ways for organizations to do this. And this is where we really see organizations starting to focus today. So what does a distributed model really look like for my organization? How does it take shape? And of all these models, which one is the right fit for us? And there are implications like around shared seating. We don't think that that's going to be a preferred model coming back, but certainly neighborhood hoteling and activity-based settings, we think are going to be the predominant weight as we come back to the office. And if you look at historically, the companies that have been very successful in a flex work or a portion of time spent working remotely, a portion of time in the office, roughly a 60-40 split of 40 to 60% of the time spent either in the office or at home, but not 100% of the time spent in either environment. So we think that's where we'll gravitate to. And as we start to look at this, we think that it's really going to be in 6 to 9 month buckets. And so short term has really been the last 3 months and the upcoming 3 months as we get back into the office and really understand what a managed and distributed workforce looks like. As we go 9 to 24 months, we'll start workforce modeling around these different scenarios. So will we look at neighborhooding? Will we look at other opportunities? But that's the point at which we're really going to start designing and planning modifications. We're seeing very few organizations really look at modifying their footprint today. And we don't think they'll start planning that until we really get to a point that we have a vaccine, which we should have this month, the month of July, and we have it widely distributed by the end of the year or the beginning of next year. And then long term, and this is really where the real estate factors start to factor in as we get into lease renewals and lease changes. 3 to 5 years, we're going to have an on-demand workforce. And a big part of what we think is going to shift is that it's going to be more contract labor and less direct labor in some cases. Best practices are going to evolve because there's nobody that was really out in front of this scale of change across all aspects of how we live, work, and play. And so it takes 3 years to really start to recognize an evolving best practice. So to have something happen, to react to it, and then be able to measure and prove that it's a best practice takes that amount of time. And so there are a lot of key questions that really come up for leadership. Are we going to be okay accepting remote work? And as we get into the next 9 months and start to see erosion in productivity working from home exclusively, how are we going to handle that from an organizational perspective? I mean, realize that we're all going to go through the end of this year, in most cases, a performance review with a workforce that was shoved into working from home. And so our empathy and tolerance for productivity associated with that and how that's going to change over time is going to be a good measure of organizations, but also it's going to be a big rubber stamp on whether working from home was a good idea or a bad idea through all of this. We're going to see a lot of workforce models change as part of what I mentioned around contract labor. And then how we measure organizational performance. And Scott and Amy, I know you touched on some of this. From a financial perspective, we look at performance. It's going to be interesting to see of those companies that recover with a V or a W or an L or a U, how we measure their performance based on how they brought the workforce back and how engaged their workforce was as they came back. And so different ways to look at that performance and even gauge value. Something that literally we just started, the new iOS application that came out with a recent renewal is contact tracing. We haven't really had this before within the model. And so you're also going to see as we go through this second spike and the waves that are associated with it, this need to test more widely, to isolate anyone who is infected or exposed, to find everyone that they were in contact with, and then to quarantine for 14 days. And so think about this from an implication from an organization that has a critical team that's all working together. They probably don't want to expose them to outside influence or outside people at this point. And so kind of the herd aspect of what we've been talking about and kind of managing critical herds within our organizations is going to become more important. And as organizations, we're going to have a responsibility to actually report back and to do this contact tracing. So we're now building the foundational infrastructure to really kind of measure and maintain as we start to come back in the process. Other things, and I think Scott, you touched on some of this, two new technology applications, certainly touchless, but things that also provide access or an opportunity into new services, or really truly a touchless lifestyle. Thermography and kind of metrics around body temp and inflammation are going to go nuts. I mean, we already have platforms where we can measure heart and lung inflammation in a walk-through model, and that's a much better indicator of exposure to the virus than just temp. So, all the conversations you've heard around temp's not a great measure, you're going to see massive change around other ways to kind of quickly and accurately measure biometrics. Scott, I've got a ring that actually measures my biometrics and does data security. So I can pay you with my ring. Some cases I give it to you, but yeah, I think we're going to see other things and other technologies around that are really going to take off as well. And the price point and the acceleration is going to be drastic there as well. So the last big implication, and this is probably the biggest thing that we weren't prepared for as employers and truly as a culture, is the CDC and OSHA guidelines require that or provide that employers need to communicate very clearly, very specifically at different levels within the organization, the protocols for coming back. So if you don't do this and do it well, you're at risk. You need to measure everything from the policies you have in place that may be contradictory to the behaviors that you're trying to drive. So like in the state of Georgia, we had a law that said you could not wear a mask. So we had to actually undo that law so that you could wear a mask in the state of Georgia. Gives you some idea of the state of politics here, but when you look at it from an organizational perspective, you probably have some policies that are counterintuitive to working from home, that are counterintuitive to what we're going through. And also from a just communication perspective, it sounds simple to explain to someone how to wear a mask and wear it in the right way, but it's not. And so really helping people understand that they come back is both critical from a public health perspective, but also critical from an organizational perspective. And then from a physical environment, again, in most cases, with the population that we're going to have coming back before we have a vaccine, we're not making major changes to the physical environment. It's really about kind of limiting the capacity and making sure we socially distance. So what we're seeing from a market shift there is not drastic change, but more of a wait and see approach. And so all this is available. We have links on our website. We host video conferences and do conversations like this. We're doing a lot of audits as we go into this next phase, and organizations are looking to bring people back. And then if there's any way that we can provide assistance, we're trying to do that. What we're going through is probably the most disruptive thing that most of us will see in our life cycle. And to a great extent, that the real value that we can provide as an organization is helping you weather this in a way that keeps your business healthy and sustained.
Thanks, Roy.
So thank you all.
Roy, thank you so much. We appreciate that. We hope that the Covington team and everyone on the call was able to learn something from that. Roy has such a unique background in this and has been really instrumental in working with a lot of our clients and companies we work with around the country to figure out not only when to bring people back, but more importantly how to do it in a way that is thoughtful and recognizes that there are different comfort levels everywhere, and that does it in a very healthy way. So Roy, we appreciate it very much. Thank you. Jen and I, for all of our webinars and everything we do, because there's so much negativity, we wrap up everything we have a couple different preferred ways of doing it. So on our LinkedIns and Instagrams and on our website, which is officecreated.com, we have something called 3 Good Minutes that we're doing right now. It comes out every Thursday. The next one comes out tomorrow. And at the end of 3 Good Minutes, we always do one good thing, something positive in the world. So sometimes it's hokey. I think tomorrow I make fun of my COVID hair, which is 3+ months in the making here. I'm very proud of that. But our one good thing this week, so I never binge watched a show before in my life until now. My favorite show that I've ever binge watched in my life is called Riverdale. If you haven't seen it, you should watch it. It's amazing. So that's my one good thing this week. Jen?
Well, hold on before I go. Scott, Amy, Susan, I know we didn't talk about this, so we're not going to put you on the spot, but if anybody wants to unmute and join in with one good thing before I wrap up, feel free.
Baseball's coming back.
All right.
That's a good one.
Ryan's with you on that one.
Yes.
Scott or Amy? No? Okay.
No. All right.
Well, we filmed our 3 good minutes for Thursday earlier today, and I'll use the same one. We're going to be talking about subleasing on 3 good minutes coming out tomorrow. And I'm really late to this party by like 5 decades late. Ryan's laughing, he knows what it is, but I bought a crock pot and it's awesome. And I totally get it. Totally get it. So that's my one good thing. But in all seriousness, Covington, thank you so much for all of your support. You guys put out great information. We're so happy that we could do this with you today. Roy, as always, and to everyone on, we've had a lot of you on the Zoom right now. I know that's a ton of information, so in a very short amount of time. So thanks for joining. And if you want, like Roy said, any of the information, either from Newmark or from Covington, please reach out. You're going to be getting a email follow-up with just a brief survey. If you are so inclined to take that, please do. And stay safe and healthy. And we look forward to seeing everyone again soon.
Be well. Thanks, everyone.
Thanks all.